Okay, folks, August 2017, we finally made it. It's the last month of the mentorship's teaching, and this is going to be teaching the ICT long-term top-down analysis. I'm going to be going over how I personally go through the monthly chart to arrive at levels that would be transposed and ideas to the weekly chart. All right, so before we begin, it's important that I remind you all that I've provided you a ton of information over the last 12 months, and a lot of that information is going to be flexible for you to adopt as your own. Okay, there's a lot of analysis concepts that are very strong on their own, but obviously the best way to use this information is when it's in concert with other things that support the ideas. So the more things we have in confluence supporting a specific idea or bias or analysis view or perspective, the better. Now, obviously, not everything's going to be in alignment. It's never the case, like everything else in the world. But if we have a sampling of similar ideas overlapping or converging with the same premise, then we generally have a higher odds of the outcome being our favor. So before we begin, I just want to remind you that this is my personal approach. Okay, it's how I use this information, how I internalize everything in the actual daily process that I go through. Well, in this case, every month when I go through the data at the last trading day of every month, as soon as the market closes, I go through this specific pattern of processing and looking at the data, and all those things go in hand with what you're going to be taught in this teaching. So I try to do this level of analysis once a month, and it's usually the close of the month that just ends. Okay, and ideally, if it happens on a weekend, I can get to do a lot more in-depth detail. But generally, months don't always end on a weekend, so they many times will end midweek, and you'll have a beginning of a new month immediately the next day on a particular weekday. So this is the analysis that I do personally, and how I do it, and what brings me to my monthly perspective that gets transposed onto the weekly, which we'll talk about in our next discussion. But this is all primarily long-term. And I'm going to show you just how easy all the things that you've been experiencing through this mentorship, how you can take just some of the things and apply it and arrive at the outcome that you're looking for in terms of analysis. So what's the focus of this presentation? Okay, we're going to determine the impact of the monthly perspective on an asset or market, and we're going to identify the directional bias for the higher time frame monthly chart. We're going to classify the PD arrays accurately to assist in key levels. We're going to complete an institutional analysis on a monthly basis at the end. And it all starts here. Seasonal tendencies. Now, obviously, there isn't a seasonal tendency for everything every single month, but there are specific times of the year. And this is the reason why, and I want to preface it as well before we get any deeper with this. I mentioned that the PDFs are going to be useless to anyone that has not gone through the content and hasn't gone through every individual lesson. So the points that you get stuck on in here, you're going to have to go back into the coursework and amplify your study and go into greater detail and just research it. And plus, if you still can't get it, you get 3 more months after the conclusion of this month where you can hammer me with questions, and I will do my utmost best to get you in sync with what I view in terms of analysis. But it starts with seasonal tendencies. So every day, we're bombarded with time. What's the calendar date today? Well, at the time of this recording, we're in August. So we would be looking for August seasonal tendencies or September seasonal tendencies that are coming up into next month's trading. Obviously, you can't do much with what's already happened in July and June. It's already passed. So whenever we sit down with our analysis, God forbid, say something happened that we were taken away from the markets for a period of time, or we have been ill. Okay, we just taken a hiatus, something like that. We've been away from the markets. Say we just sat down today, and what will we do today to get ourselves in line with the higher time frame and start working towards that lower intraday perspective? Well, it starts again with the seasonal tendencies. So I've given you a great deal of seasonal tendencies that I like for every asset class. This teaching, I don't have to break it down so much in terms of stocks we do this, and commodities, we do that. Everything we see in this teaching is synonymous across all 4 asset classes. Okay, as we get closer into the smaller time frame stuff, there's a lot more specific things that have to be done for respective asset classes and specific markets. So this one's a broad brush concept or presentation where it covers every asset class: stocks, bonds, currencies, and commodities. Okay, and the next thing I like to do is I like to refer to the quarterly shifts. So we like to look at how the market is predisposed to move every 3 to 4 months. There's some kind of a new cycle or market shift that takes place in the marketplace. And we have to be reminding ourselves that whatever's been happening in the last couple months doesn't always equate to a continuation of that thought process. Many times we'll see that it does, but we have to always be in sync with the likelihood of a sentiment change or shift in the market structure where the market will go from where it has been going lower for a few months. Then we can actually make a long-term low or intermediate-term low and trade higher for a few months. So I like to look at the analysis with the anticipation of saying it's going to either continue or likely reverse in the coming 3 to 4 months. The next thing I do when I sit down, I look at the interest rate differentials. Okay, and I taught you that at the beginning of the year in 2017, how to do all that, and we'll go over a little bit more detail later in this discussion. But the process, again, is seasonal tendencies. That's the first thing I look for. Right now, the month that we're in, what's going on, what's likely to happen. And then I anticipate or forecast the quarterly shift that may unfold in the next 3 to 4 months. And then I look at the interest rate differentials. So what I'm already doing right now is I'm looking at a time study in the basis of calendar with the quarterly shifts, and I'm overlaying with the idea of, is there something seasonally that may impact the price? So there's 2 references of time. Okay, so I start there all the time. Remember, my concepts are primarily time and price, not price and time. It's time, then price. So I'm looking for things to give me an edge from a statistical standpoint, saying in the past it's done this around this time of the year. Well, it doesn't always equate to that, but I would rather trade with that idea first and foremost in my analysis concepts than not have it at all. So once we have a time element, now we got to start looking for reasons to justify why price should do it. Okay, and if we're going to be referring to currencies, obviously this is the portion where interest rate differentials have to kick in. If it's going to be stocks, we would be looking at the bond market. Okay, is the bond market moving lower? If it is going lower, that means interest rates are going higher. It's going to be harder for stocks to maintain a bullish market. And if bond prices are rallying, that means interest rates are going lower. And generally, that's going to be supportive of a bull market in stocks. Commodities, everything's going to be reverse based on the interest rates. The next thing I consider when I do my analysis, I'm looking for the market profile. Okay, I want to know what we're doing right now, what we have been doing in the recent months. Have we been trending? Are we consolidating? Are we reversing? Those types of things. I want to know, are we part of a trend right now? And if there's a trend, that means certain things can be anticipated or expected. And if it's not trending, those things also have an impact on our expectations. So I consider what we're doing in terms of the market profile. And then I start bringing in other markets that are correlated positively and negatively. So I look at other markets to support the idea that I'm starting to see in price. So I'm looking at things seasonally. I'm anticipating a quarterly move over the next 3 to 4 months. And I'm looking at markets that have a fundamental reason to go higher. That's what interest rates are. Remember, interest rates are the #1 driver across the board on all asset classes. So if you don't understand interest rates, you're not going to get anything out of any of the market analysis concepts that I've provided thus far. But once we have a fundamental support behind higher or lower prices relative to the interest rates, the market profile is referred to next. And then after knowing what profile we're trading in at the current time, I look at other markets to support, okay, or negate. Sometimes it'll negate a trade idea, which is why you want to refer to other markets that are closely correlated, whether it be positively correlated or negatively correlated. And then I look at the market structure itself. This is where I want to see where we are in the scope of higher highs and lower lows, and are we making intermediate term, long term, or short term highs and lows, and how does that nest out in the grand scheme of things. And also, this is where we refer to SMT studies like divergence and correlation ideas. Okay, and then I look at the PD array matrix, and I want to define the market in terms of a premium and discount. And then relative to the PD array matrix and those reference points and focal points using that concept, I will calibrate the levels and come up with key price levels as a result. And those key price levels are where the trade ideas will come to fruition. They could be either in terms of an entry, or it could be objectives or targets. And by going through this entire process, step by step, in order, in this way, I end up getting to a monthly bias, and it defines my expectation on what I think the monthly chart is going to do. Now, some of you don't want to be long-term traders, and that's fine. There's nothing wrong with that. Okay, I don't like to be long-term traders, but I still go through this process. And it sounds like a ton of things. It sounds like it'd probably take you 4 hours to go through all that stuff. And some of you are probably thinking, is this guy really want me to do this every single time I take a trade? No, just once a month. Once a month, you have to define what it is you're looking for, okay? And then as the new month comes, you'll do the same thing again, okay? So you're going to be doing monthly analysis, basically one time a month. You only have a candle forming once a month on a monthly time frame. So you have to look at it at the beginning of the month. And preferably as soon as the previous month closes, you want to be doing that analysis, especially because, unless it falls on a weekend, like for instance, if the previous month closes on a Friday, well, that gives you a weekend to do the analysis, but you're not always going to get that now, are you? You're going to get a month that closes during the week, and you'll have to do your analysis to get in sync with the next month's trading immediately the day that the market closes. So by having all this process, you end up, or I end up, with a bias that's defined from a monthly standpoint. And what I do with this is I take this information and I transpose it to a weekly chart. So everything that I glean from a monthly chart, whether it be stocks, bonds, currencies, or commodities, all of those ideas get translated and put onto a weekly chart. So when we look at weekly charts in our next teaching, where we go from weekly down to a daily, that will give us more of an intermediate term perspective. So this is all that it requires for me to come to a long-term bias. Now, there's other things that we can do to help qualify and confirm some things, and that's based on inflationary or deflationary conditions, like I taught in January. I'm going to counsel you to go back through January's content. It's a lot of stuff in that particular month. But you can fill in a lot of the gaps that would not necessarily be seen in here. But I like to look at things like are commodity prices dropping? If we are, we're in a deflationary condition. If commodities are going higher, that's in an inflationary condition. And those specific conditions have an outcome that's most likely going to occur. And I give you those in January. But really, the easiest way for me to look at inflationary, deflationary, I just follow commodity prices. If they're going higher, if generally all as a whole they're going up. Not all of them will go up. As we taught in the mentorship, there's going to be some deviations in that, like anything else would be expected, because everything is not black and white. But if the majority of commodities are trending lower or making lower prices, then we are in a deflationary condition. That means prices are they're just decreasing. But if commodity prices are going higher, then we're in an inflationary condition, and that's going to have an effect on the markets as a whole. So, but basically what we get to and arrive at is a monthly bias that gives me what my expectations are for not only the next month that we're about to start, or just the month after that, or maybe even the month after that. So I'm trying to forecast 3 months of price action. It can go 4 months, just like when we look at quarterly shifts, we can go look back at the last 3 to 4 months. We are not rigid in that regard. We want to have a little bit of flexibility. So when I look at today's data, when I'm looking at like quarterly shifts, I want to look back the last 3 months, but then potentially even 4 months to see if there is something I might be missing. But when we're forecasting and doing analysis, we are, in my opinion, I'm trying to forecast the next 3 months movement from a long-term perspective. I may not be accurate, I may not be right, okay, but if I get just half of the monthly candle that's about to be painted on the chart, if I can get that right, that's many times enough for me to be profitable for the month. And that's my point. You don't have to be right to be profitable, but you're going to be finding yourself more apt to be right if you do the things that we're doing here in a structured approach, in a step-by-step process, and going through each individual component one step at a time and arriving at that information and then building layer upon layer until you get a foundation that builds on the monthly bias. So once we have all these information, we take it over to a weekly chart and we can start using that on a weekly time frame as well. So seasonal tendencies, this is exactly where I begin. So I start with the calendar month we're in and or about to begin, and I refer to the seasonal tendencies that are taught in this program. There's so many of them, it would be ridiculous for me to go through them again, and it's like rehash, and I'm trying not to bog you down with needless study. I'm pulling all the information into a user-friendly approach. That's what this whole month's about. So you can go through and find out what seasonal tendencies are good relative to specific months, and then you can just put that on your calendar. Every year, every time you buy a new calendar, or if you have a smartphone, just plug it in. You know, this month I'm going to be looking for hogs to go up, or I'm going to be looking for euro dollar to be going down. You know, all those seasonal tendencies, you want to know them before the month starts. Okay, and that way you can get yourself in sync with a potential quarterly move, and that quarterly shift, if it's on the right side of a seasonal tendency, wow, you got it. Again, not every market or asset class is going to have a seasonal at the moment, okay, but focus on the ones that do have a historical repeating nature on how they come to fruition more times than not. And Steve Moore has the absolute best in terms of commodities and currencies. And obviously, you know what the seasonal tendency is for bonds. I already gave you that, and I've already given you a seasonal tendency for equities. If you're going to be a stock trader, it's only 2 of them a year, and the one is I like the most is the fall. It makes a seasonal low. So I want to focus on the markets that historically at that same time of the year will likely move in similar fashion. Okay, so again, it's not a panacea, it's not a be-all end-all, but seasonal tendencies help me plan the best potential big movers without even needing to know what price is at. I know there are certain times of the year I want to be doing certain trades. Now, I don't force myself into that trade, but I look for things like we just outlined in a step-by-step process from a monthly standpoint to justify why that seasonal tendency might have an impact on price this year. And the seasonals are specific, and you've been delivered over the last 12 months, and you got to go back and look at them respectively to their asset classes. I'm not going to redo them or relist them here. It's too many of them. All right, and next I try to determine the next quarterly shift or market structure. And I refer to the long-term 9 to 18-month trend. This is on a monthly chart. And if the direction is bullish, that means if we've been going higher over the last 9 to 18 months, I'm going to still try to justify why the next quarterly shift might be a buying opportunity, because I don't want to buck that trend. If the direction is bearish, I first start to justify why the next quarterly shift might be a selling opportunity. I'm trying to avoid picking the tops or the bottoms of the 9 and 18-month trend, and it has nothing to do with new moving averages here. I'm just looking at the actual candles going back 18 candles on a monthly chart. I want to see what we've done. Okay, that's going to be like my primary range. I want to work from that. You'll have to calibrate that. It might go a little bit further to the left to find out where the seasonal, it's not seasonal, but the short-term high or long-term high or whatever market structure high would be in the last 9 to 18 months. For instance, say you find a market that has 27 down days, and in those 27 down days, you may be sprinkled with 4 or 5 down candles. I said days, I should be saying monthly candles. You want to be looking at specific portions of price action. And I start as a bellwether. I like to look at the 9 to 18 months range on a monthly chart and get a feel for what it's done in that span of time. Long-term trends tend to remain in place for some time. And if the 9 to 18 month trend is not clear or it's in consolidation, my personal approach is I will elect to anticipate the direction of the previous 3 to 4 months direction to reverse. So whatever it has done the last 3 to 4 months, if we are in a 9 to 18 month consolidation, or I just don't know what the trend is, if it just doesn't look clear to me, I'm going to anticipate some measure of retracement or reversal for the coming month or two. All right, next I refer to global interest rates, and I use websites like investing.com. You can use that link that's here. And what I'm doing is I'm locating and comparing the central bank interest rates for every major country, and I look for the differential trades that way. So what I'm doing is I'm trying to find high interest rates to pair with a low interest rate country and to basically form a forex pair so that way I can adopt a fundamental bias. So if we are looking at currencies across the global front, this website here gives you the current interest rate, and it also gives you the last time it changed and what the change was, how much of a change, and when the next change is anticipated, or when the next meeting, let's say it that way. And ideally, both seasonal tendencies and quarterly shift expectations are going to be in alignment with interest rate differential trade ideas. It may not be like that, but ideally, all three should agree. And this is what it would look like if you go to that website. And this is what I mean by it. It gives you the current rate. And for instance, we'll look at the European Central Bank right now. At the time of this presentation, it has zero interest rate. And the next meeting is planned for September 7, 2017. The last time they met and changed was in March of 2016. And they dropped to 5 basis points. So we went to zero interest rates in March of 2016 for the European Central Bank. Bank of England right now has a 0.25%, and they're planning to meet also in September 14, 2017. The last time they changed was a cut of 25 basis points, and it was in August 4th, 2016. And basically all I do is look at that current rate column, and I look at which one has a high rate and I group it with a low rate. And for instance, we have Bank of Canada. It's 0.75%. And if we look at Australian dollar, we have 1.5%. And I already outlined the scenarios there, and we used it in the mentorship to help frame some ideas. But I'm actually going to use this chart later on in an example, but we'll look at that later on. But right now, this is what I mean when I go through and look for the global central bank interest rates. This is where I get the information from. It's right on investing.com/central-banks. Okay, after that, what I do is I define the current market structure. Okay, and the current market structure, I classify the recent highs and the recent lows. And what I want to do is I want to compare them. I want to compare them with positively and negatively correlated markets. Basically, I'm looking for SMT divergence. And then I compare the relationship to the highs to recent highs to determine if the long, intermediate term, or short term highs are in control of price presently. In other words, are we making higher highs? Okay, and then we recently made a lower high, and then we made an even lower high after that. That means we probably made an intermediate term or long-term high. Okay, and this is all taught in my basic market structure stuff. If I see that relationship in the highs, okay, and if it is at least implying that an intermediate term or a potential long-term high is formed, then I'm going to be looking for reasons to go short. Now, ideally, that's going to be in pairs that are with weak currencies paired against a strong currency during a time when I anticipate lower prices and a quarterly shift. At the same time, a seasonal tendency is most likely calling for that currency to go lower, or that market to go lower, and the profile is trending. That would be an ideal scenario. And the reverse would be said for when I'm looking at the relationship of the lows. I compare the market lows to recent lows to determine if a long, intermediate term, or short term low is in control of price presently. If we see a market that makes a low, a higher low, then a higher low than that, then we can potentially see or anticipate the fact that we've made a long-term or intermediate-term low, and there may be further upside to go. And then we'd be looking for instances where there's a seasonal bullishness to come in. The profile is trending higher, okay, and the quarterly shift, we would expect it to be another few months trading higher as a result. So that's how we would use the information. And ideally, for when we're looking at the market that has a potential long-term or intermediate-term high in place, we would expect lower prices. By comparing those highs, we would see hopefully a SMT divergence from a correlated asset or against the dollar. If it was foreign currency, we would want to see a failed lower low with a higher high in the currency we're looking to short, or a failed lower low in the dollar, as we just gave an example of. Would be another opportunity would be if we made a lower low in the dollar and a failed higher high in the foreign currency. That would be an SMT divergence, and that would also help us with market structure ideas. So basically, it's just looking for SMT divergence and looking for market structure to support another price leg higher or another price leg lower. Now, trades selected in the direction of the current market structure are going to be favored in my analysis. So if I can see clear reasons why market structure should be going higher, and seasonal tendencies are suggesting that's in line as well, then obviously that's what I'm looking to do, and I'm only going to try to focus on those types of trades. I won't try to fade those types of moves. I get a lot of questions. When do I want to do reversal trades? When do I want to do counter trends? I don't want to counter trend in these conditions where I have market structure and S&T behind me and seasonal tendencies behind me, and against the interest rates. I don't want to trade against that. If all these things are together, I will never want to fade that. I'll always only want to be a buyer in that bullish scenario or seller in that bearish scenario, and I would never deviate from that, regardless, not even on a scalp. And then I look for confirmation in other markets, and this is by way of inter-market analysis. So if I have a bullish market structure and everything before it is also supporting higher prices, and I determine that in my market of interest, I look for inter-market analysis to support this idea in positively correlated markets and opposed to it in negatively correlated markets. An example would be bullish dollar. If I'm expecting higher prices in the dollar, I'd be looking for weak prices or potential sell scenarios in the gold market technically. A bearish market structure, okay, when I'm expecting lower prices and seasonals are behind it, and I have a pair that would be grouped with a weak against a strong, and I'm seeing this in my market of interest, what I'm going to be doing is I'm looking at intra-market analysis to support the idea in positively correlated markets and or opposed to it in negatively correlated markets. An example would be if I'm bearish euro dollar, I'm going to be looking for strong dollar technically. Something else that would be supportive of that would be if I'm looking for weaker euro dollar and I'm looking for stronger dollar as a supporting factor, we can use gold again as a supporting factor to further confirm it by expecting lower prices in the gold market. Now that changes when we go into conditions like what we have now. We have potential war scenarios that may be a catalyst for the flight to quality, okay, or safe haven, where gold won't be that supportive behind your trade because it's being driven by something outside of normal, which would be it's being treated as a safe haven. There's a lot of things going on right now as it relates to North Korea, and people are seeing the slide in the dollar, so it's safe haven. You can see the gold market rallying as a supportive thought process there. What profile is the market in? Okay, and what I do is I sit down. The first thing I want to know is, are we consolidating? Okay, I don't ask if it's trending first or anything. I'm looking, are we consolidating? Because that tells the tale. Consolidation is the beginning of the next move. So if the answer to that question when I'm sitting in front of the charts on the monthly is yes, then expansions are likely to show evidence prior to the breakout. In other words, I'm looking for things to justify which side of the market's going to go first. Is it going to be the highs or it's going to be the lows? Is it going to break out to the high? Is it going to break down to the low? I want to be looking for evidences and signs to support those theories. And if it's no, the question is whether or not it's consolidating. If it's no, then the trend might be reaching an extreme. If it's not consolidating, that means it's trending. So I want to look and see, is there reasons to justify why the trend that has been in place, is it likely to hit stiff resistance? Okay, because if it is, retracement's likely. Okay, and the next question I have is the market under a trending environment? And if the answer is yes, then I look for continuation in those trades because trends tend to stay in place. But obviously the notion is trend is your friend, but not in the end. So I look for continuation trades to avoid the top and bottom picks. But if the answer no is the market trending, that takes it back to it's consolidating then. So I look for signs to support a directional breakout, and I'm going to be using intermarket analysis to do that. And is the market under a retracement? So if the answer to that is yes, then I look for signs of continuation trades post retracements. In other words, I'm going to be looking for reasons how far is it going to retrace down to, and you just use the PD array matrix to get to those answers. But I want to be anticipating that retracement getting to a specific price level and then looking for the continuation on the upside or downside relative to the trend. And if the answer is no, it's not retracing, then I determine if consolidation or trending, and I use the above ideas as outlined on this slide. So it takes a little bit of thought process, and there's going to be a lot of scenarios that come up, and you're going to read it wrong, you're going to do things wrong, and like you've seen over the last 12 months, I am not right all the time. I can't be right all the time. I'm human, and I'm going to do things wrong. I have a lot of things going on during this mentorship that's very distracting. I have a personal life that's very distracting, and you are going to have the same things happen in your life too. So you're going to have difficulties. You're going to hit, potholes and pitfalls, and you're going to hit snares, and you're going to make a mistake, and you're going to do things wrong. But these are the questions I ask going in to determine what the market profile is, and I use the ideas that's suggested here to lead me to my next course of action, or wait until more information comes. Okay, then I locate the institutional focus points, okay, and that's going to be in the PD array matrix. And once I arrive at a portion of price action I wish to analyze, that being within usually the scope of the last 9 to 18 months. It can deviate a little bit based on the market structure, but I look about that far back on the monthly chart, and I break down the selected price range into premium and discount. And not every price range will have every possible premium and or discount array. I just note the ones that are obvious in the price range. Now, both the premium and discount arrays are noted. I will look to build potential trade ideas based on the PD arrays and referring to all the previous analysis points thus mentioned in this presentation. That means I'm looking for the supporting idea of a seasonal tendency calling a direction. Doesn't mean it's going to happen, but I'm looking in that direction first. And then I look for signs and technicals to support that and fundamentals through the interest rates. So I'm blending all elements, time, price, fundamentals because of interest rates. Okay, but I'm looking for the PD array matrix to support the idea of having what specific levels in a premium range should I be focused on, and what discount arrays should I be focused on, so that way I can really get to a closer understanding of where real buying and selling should come in. Which brings us to where I note the key price levels. Once I determine the portion of market structure I want to use for my trade ideas, I round each PD array to the nearest 10 level, or 0 level, or 5 level. Now, it's going to be a matter of preference, whichever gets closer to the actual PD array. Now, to calibrate these, the premium arrays above market price, or wherever we're trading at the time I'm looking at the chart, I round down to the nearest adjusted number. So that way I calibrate to the nearest 5 or 0 level. And I'm rounding down. So if it's above us, I'm getting as close as I can by getting the nearest 0 or 5 level that closely aligns with the PD array matrix premium level, but I don't ever want to round up to it. I want that low-hanging fruit. And for the discount arrays below the market price, or wherever the market's trading at the time, if I'm looking for discount arrays below us in price, I'm going to round up to the nearest 0 level or 10 level and or 5 level, whichever gets me closest to the PD array matrix, discount array, but doesn't have to be required to round up to it. Okay, again, I want that low-hanging fruit, the nearest objective. And once I do that, what I end up having is the actual key price levels from a monthly standpoint. So those monthly levels, now they've been calibrated, they've been supported with the institutional mindset of a PD array matrix, discounted premium, and now I have a directional bias because of all the factors we went through in this process. So after referring to the potential or possibility of a seasonal tendency, I anticipate a specific quarterly shift directionally. I'm pairing strong to weak interest rates, okay, or vice versa relative to the trade idea. And I'm determining the current market profile. Are we consolidating or are we trending? And I confirm my analysis with correlated pairs or markets for intra-market analysis. And then I select a portion of market structure to frame a trade within. So I'm defining or trading inside a range and using that for internal range or external range liquidity. Then I define the PD array matrix to get the premium arrays and discount arrays to arrive at key price levels from the monthly standpoint. And then once I have that, I'll have a directional bias that's basically, all framed from a monthly standpoint. So that directional based analysis on the monthly time frame gets transposed over to the weekly chart. So let's get an example of this, and that way you can kind of see how the step-by-step process is. And it's not much work at all, and it's very simple. And that's really one of the hallmarks of this month. It sounds like a lot on the description side of things, and it's a lot. But because you went through all the things from a conceptual and component standpoint, you went part by part modularly. I gave you each individual component piece by piece. So now where you're lacking your understanding, you'll be able to go back and find exactly what it is that you need to work on. Or it'll help you get to the questions that you need the answers to. So the next 3 months, when we get past August content, you'll have a better use of that time, and I'll be a better teacher to you because I'll put you in a better place so you can ask the right questions. And then by asking the right questions, I will have hopefully the answer you're looking for that fills in those gaps. Okay, so let's take an example using this information, and it'll help beat home the importance and the process that I use from a monthly standpoint. Okay, folks, we're looking at the Australian dollar, and I'm going to bring some things out to you. We're looking at the last week of January. There's usually some kind of a low that forms. Then there's another stronger low that forms in the month of March, leading up into May. And then there's usually a June-July low that forms. And then there's some measure of weakness that takes place from August down into October. Okay, so the seasonal tendency here we're going to focus on is January. There's usually a low forming in the Australian dollar. Then there's a low that forms in March. It was a strong rally. It takes us up into May. And there's a tendency to create a summer low in the June-July time period that trades up into around August. And then we can get some weakness. Okay, so I'm going to be using this as my idea or framework for the seasonal impact. And we're going to be trading the Australian dollar. We're going to be looking for a way we can do this seasonal tendency. Okay, and we're going to look at that as an example. Okay, here we have the Australian dollar. This is the monthly chart. Okay, and I kind of want to use the June time period as our study. So I'm going to actually just block this off here in the May month. So where that May candle ends, we're going to hypothetically say that we can't see this price action. Okay, and I want you to remember that we called for these types of moves here, and we were looking for bullishness. We were looking for this candle in here also to act as support, which we'll outline here in a moment. But I just want you to know, go back and look at the information we gave around the Australian dollar, and you'll see everything that's here we talked about. Okay, so all right, so we're looking at the January, March, and then June expectation for higher prices. Okay, so this candle here is January 2017. Okay, and price did in fact rally as one would expect in terms of the seasonal tendency. Here's February, then March. Now March, April, May had a decline. So we had a little bit of an opposite effect going on in seasonal tendency, but then we get back into another time period when June we anticipate bullishness again, okay, based on the seasonal tendency. So now we have a quarterly shift too. What's happened here the last several months? It's been going down. Okay, so the question I ask myself is, we have a seasonal tendency, okay, and we're referring to June as our setup here, okay. Our seasonal tendency was expected or expecting higher prices in June, and the quarterly shift has been, the last couple months, it's been going lower, okay, and at the end of May, getting ready to go into June, what we're trying to forecast is what takes place in June. So this month right here, when this ends, we look back 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18 candles, okay? 9 to 18 candles. So if we look at this back here, price has been really in a consolidation, okay? So I want to know what the price has done, in the last 9 to 18 candles on a monthly chart. And if you look at what we've seen, though, we've seen price come off of a low, at a higher low, and now we've seen some measure of retracement. So the question is we have had, up to the end of May, we had 3 months of down movement. So there's 3 months of down movement. We need to figure out, what does that mean? Does that mean that we're going to see continuation of that going down? Or is that more like a retracement? We'll have to look at some things as we go through our process. But the next point of concern is we have to look at the rate front. In other words, what's the global exchange rates for the central banks? And since we're looking at the Australian dollar, we got to look at what the relationship is between the Australian currency's interest rate and that of the Fed for the dollar. So let's take a quick look over at the website that does that, at investing.com. Okay, we can see all the interest rates here listed. And we're looking at the Australian Bank, the Reserve Bank of Australia, and the interest rate is 1.5%. And the last time they changed was August 2nd, 2016. They cut it 25 basis points. And the next time they're meeting is September 5th. We have an interest rate of 1.5% for the Australian. And for the U.S., our Federal Reserve interest rate is, at the time of this recording, it's 1.25%, but they just changed it and raised it 25 basis points June 14, 2017. So really this was actually 1% versus Australians 1.5%. So which had the higher interest rate? Australia. So from a differential standpoint, Australia had a higher interest rate than that of the American dollar. So by itself, fundamentally speaking, the yield attraction is better in Australian than it is of the dollar. Okay, so we have seasonal tendency to expected to go higher in June, and then we expect a quarterly shift to take place, and the rate differential is showing that the Australian dollar is higher than that of the dollar, as it was shown here prior to June 14th. The interest rate was at 1%. So now we got to look at the market profiles. Let's go back over to our charts. Okay, and going back about 18 candles, you can see the market profile has been in consolidation. Okay, so we've been in a range, and it's important that we don't want to focus on any of this over here. So we have to basically pretend, if you will, this price action isn't there. Okay, it's going to be to your learning benefit, but in a moment, just for now, just ignore this. Okay, so we've been in a range or consolidation, but inside that consolidation, we got to look for clues. Remember, the market profile, if it's consolidating, we want to know if it's going to give us an upside or downside break. So the way we do that is we start looking for intermarket analysis. Okay, and now we're going to bring in the dollar index. Okay, we'll bring in the dollar index on a monthly chart. Okay, and you can see the monthly chart prior to, well, here's August, July, June. Right here in the month of May, we've had prices dipping down, dropping lower. Okay, so from a quarterly standpoint, this has been dropping Okay, do we look for a reversal for the quarterly shift for the dollar, or do we support the idea that it's continuously going lower? Well, we have to take a look at the market profile in this currency as well. Prior to this high, we were in a consolidation. All of this was a range. Now, I spent a lot of time giving you the outline. About 38 minutes was describing the step-by-step process. But look how fast we go through this. Okay, I want you to keep in time how much I'm actually doing time-wise to get to this outcome. Consolidation, and we broke out of consolidation. So above equal highs, this is always going to be potentially what? A stop run, even on a monthly basis. So it could be a failed break and then come back down inside the range, and we get that here. This is May. Okay, so in this case, we would expect the price to continuously go lower because we had a failed break here after a consolidation. So once they broke out one side of the consolidation and it comes back deeper and goes through the midpoint of that, we have to look for the potential for it to go down below the low end of the range, okay, or at least the bodies of the candles in here. And that's seen right there, okay, because the wick can always be erroneous price action. You can see price did eventually go down below the bodies of the candles from a monthly standpoint. But how do we use this for the Aussie? Well, if we go back to the Aussie, if you look at the relationship from the December low, in 2015 and December low in 2016, we have a higher low. If we go to the dollar index and we use the December high to the December high in 2015, we had a higher high. So we had a higher high in dollar. We didn't get a lower low in Aussie. So from a market structure standpoint, we have SMT divergence in here. Okay, so relatively speaking, Aussie dollar was unwilling to make a lower low, where the dollar was able to make a higher high. Okay, so this means that this is always going to be potentially what? A stop run, a false break above old high. And the accumulation is being seen in Aussie. Now we went into consolidation. Now we came down to a low and we rallied away. So we took out this down close candle, making this a bullish order block. Take the open on the lowest down close candle. Right there's your bullish order block. We talked about this in the mentorship. Price on June opened, traded down to that monthly order block's open, 73.80 right there. Okay, so opens, trades down right at that level. So now what we have is we have a range. Okay, we have a range this high and this low. Okay, this is the most recent high, this is the most recent low. So in terms of definition of what those ranges are, this is going to be for our PD array matrix, rather. Good grief, easy for me to say it now. So here's our range. Okay, and I'm going to take this off now because the SMT divergence has already been described. So at this moment right here, at the end of May, before June rather, starts trading, we define our PD arrays. From this point here, below us, we have what? The bullish order block. There's no gap in here because the wicks and all that. And then below that is the rejection block at the close at 72.16. And then below the low, which is the liquidity pool of sell stops. So there's your discount arrays. Did it have every one of them in here? Was there a liquidity void in there? No. Was there a vacuum gap? We talked about them. No, there's not. Okay. Was there a breaker? No, there's no breaker there either. Okay. You only left with three choices: bullish order block, rejection block, old low. There's no old high back here to refer to either. Okay. So you have three potential discount arrays. Now, is that hard? No. People make this a lot harder than it has to be. Because I give you the PD arrays doesn't mean Not every price range is going to have every single one of them. Okay, and chances are they're not going to be there. There's only going to be a few sometimes, and that's the ones you find on the chart. Is it ambiguous? No, it's definitive. It actually tells you exactly what you're looking for. The order block, rejection block, old low for liquidity pool. Okay, so you only have 3 choices here. First one you get to is this, the order block. It opens, trades down to it. Now that could potentially be a trade. By itself, you have to justify what's going on here. Is there reasons to see price go higher here? Well, we'll have to figure that out when we get into lower time frames. But right in here, we would expect this to be a support level. Okay, so we have this specific candle's opening is 73.80. Do we need to round that to anything? No, it's right at 80. It's at a 0 level. Okay, if it were 73.82, we would round it to 73.85. Okay, because it's above and we're trading down to it. So we have our range there, and also if we define the range that we just did here, there's our high to low, and equilibrium's up here. So we're below equilibrium in a discount market at a discount array. So all the frameworks there for our PD array matrix. And now we have our key levels, which are here. And just that quick, we've already arrived at what we would translate into a potentially bullish scenario, because June is a seasonal tendency month when we should see Australian dollar rally. We've had the last 3 months go lower, so a quarterly shift is in order. It's been in retracement. So if it's retracing, okay, was it retracing down into an order block? Seasonally expecting higher prices, and we're in a consolidation. So what's above the consolidation during the market profiles portion of this? Buy stops. So we were going to be targeting a run above the range highs in here, and that's going to be here. There's our high, and then we got a rejection block over here, a little bit farther to the left. So once we breach this, the next area of interest would be the highest up close, right in here. And we even went through that. Okay, so just that quick, that's how we arrive at whether the market is bullish monthly or bearish monthly. In this case, we've seen and mapped out rather quickly. I've done more talking than was required to determine what it is and what the range is and what the actual levels are. But just that quick, we can arrive at a bias for the market from a monthly standpoint. And the expectation is not just 1 month, but several months. And right now, we've had the month of June and July deliver very handsome rewards for being a long trader on Aussie dollar. And from a day trader standpoint, you can use these ideas to build in scalping and intraday trading only on the long side during this month of June and July, because we're expecting this monthly outcome to confirm our expectations relative to our analysis on a monthly chart. So hopefully this has been insightful to you. Obviously, we'll be building on this theme as we go through the entire month. The next teaching is going to be the intermediate term time frame and how I do the analysis. And you can see just how quick that was. It wasn't a lot of work now, was it? I didn't do a whole lot of acrobatics and do any of that stuff. But at the same time, there's so many things you can add to this to confirm and qualify. For instance, if we're looking at the Australian dollar in the monthly, one of the things that supports this currency also is it moves very well with the S&P. So if we compare what the S&P is doing, okay, in here, if the S&P is going up, which we know it has been going up, that supports this this pair as well, because Aussie usually tracks the S&P really well. And that's going to close this teaching, and I'll see you over on the intermediate term analysis.